And a very warm welcome back to AusBiz, Marcus Bogdan from Blackmore Capital. Marcus, nice to see you again. Thank you so much.
Pleasure to be here.
Boy, 2024 has been a bumper year for, let's say most Australian equity investors. Where did you see the strength and the key themes coming through?
I think two extraordinary things have happened. One, as you've mentioned, is the overall returns of the market have been incredibly robust, well above long-term averages. The second element, which has been far more tricky for an investor, has been the overall concentration of those returns. And so if we look at this year and the breakdown of the returns, 70% of those returns have just come from 5 stocks, namely the 4 banks and Goodman Group.
It's amazing, isn't it? Because we talk about the United States as being just the Mag 7, and sometimes we overlook that fact here locally. And the banks, can you believe what happened with the banks, particularly CBA this year?
Well, it's a really interesting contrast that you make around concentration, because the Magnificent 5 or 7 in the US have delivered extraordinary earnings growth. And their share prices have followed that earnings growth. In Australia, we've had that concentration of returns in the banks, but the profit growth has been absolutely minimal in the banks. And I think that's a function of the fact that how large they are and how important they are, almost 25% of the market. And to give the banks credit, their earnings have been incredibly stable in quite difficult economic times. They have lent incredibly prudently, so we haven't seen bad and doubtful debts rise, and that's also a function of higher and fuller employment. And the final element, I think, is that the banks have, for the first time in many years, been able to start to buy back capital, so they're reducing the share count and enhancing their overall value. So very different markets, the US and the US, one driven by earnings, and in Australia, very idiosyncratic around just the structure of the banks here.
Yeah, so I don't want to get too into 2025 right now, but when you think about the banks going forward, can there be very much more juice left in this run? The momentum continues for now, at least.
Well, the momentum does continue for now, but you have had virtually zero EPS growth, but you've had an expansion of their values of between 30 and 50% across those four banks. And they are now priced at record levels, not only record levels to the Australian banks, but also globally. So whilst there's nothing inherently wrong with the banks, to move forward from here, you would have to demonstrate some level of significant sort of earnings expansion, because any more expansion of that valuation from here is unwarranted.
Yeah, it's one for the record books. So you mentioned Goodman Group. Would that momentum continue? I do know that it was upgraded by Barrenjoey. For one just today, but I also have been talking to a couple analysts lately that were saying, sell, that again, it's just really expensively valued. There will be more data themed sort of stocks coming to market soon, and that there is variety in that thematic now. What do you think about Goodman Group? Only because you named that one.
Yeah, we own Goodman Group, and fortunately, it's one stock that we've owned from sort of earlier days. So we have participated in the growth of Goodman. And really, it's been in 2 parts. The first part was the excitement around logistics warehousing, online, omni-channel, being in the best positions in key cities around the world. And they executed that brilliantly. What's happened this year, there's a secondary theme that's come in, and that's been around the data centres and their allocating capital to the development of data centres. And obviously that has been the topic of the year. They have got incredibly strong sites around the world, And the other really important element is that they've been able to secure the power for those data centres as well. And so demand is incredibly high. The supply of the right land and the right power is in short supply. And that has really propelled Goodman Group to a new level. Now, we've recently taken some profits in Goodman, but it's still very much still an overweight position in the portfolio. And unlike the banks, it has continued to deliver double-digit earnings per share growth over the last couple of years. And they're forecast to grow again at really good rates this year and we think next year. And so we'll continue with the momentum. We are cognizant of how well that they've done and the value is certainly up at the upper ranges there, but we'll continue to hold it as a core part of the portfolio.
Marcus, I hope you don't mind me asking, but what other stock calls sort of went well through this year, through 2024, and why was that?
Two others. One would be ResMed, and so healthcare had a very mixed performance this year, but we sort of saw through what the GLP threat could possibly be, but think that the market will actually expand. And unfortunately, the number of people that require sort of sleep therapy is expanding as certainly as health conditions worsen. And so that's been a terrific performer, and I think it's up over 50% this year. And the second one, probably more controversial, has been Wisetech, and we've held it for a year. We have taken profits there, post holding it for 12 months for capital gains tax purposes for our investors. And again, I mean, that was a company which has got an extraordinary global footprint with huge moats around its businesses, executed incredibly well. The issues around the CEO are sort of are well documented. We moved earlier than that, not having any precedent of what was happening, but we wanted to sort of reduce our holding. We've halved our holding there, but continue to hold it because we do believe it is a world-class business. Valuation is incredibly high at sort of 100 times, but technology stocks, or the really top ones in Australia, that's what Australian investors have been paying for.
Yeah, and you, as a house, as Blackmore Capital, you don't mind paying up and holding as long as it's quality, correct?
Yes, quality is absolutely the mantra and the basis of how we invest. Valuations are incredibly important, but in this market where you've had momentum so strong, the mistakes have been made when you've sold too early and they've just continued. Now, at some point that will normalise, but for the moment, as long as the business is executing the way that it is, and more broadly around those sort of high quality growth companies, we'll continue to hold.
Look, I always appreciate when you're candid with me. Is there anything that's not gone to plan in 2024 for you?
Well, the first one was obviously not holding enough banks. And so
yeah, well, you're not alone.
No. So we're underweight banks, and obviously that's been costly in terms of weighing on performance. The second area has obviously any exposure to resources compared to the banking sector. So banking sector up 30, 40, 50%, depending on what bank. The resources sector is down 12, and that differential is unprecedented and quite extraordinary. So the likes of BHP and Rio have dragged on performance. And then Ramsay Healthcare, where we've been a long-term holder of that still hasn't I think it's certainly bottomed now in terms of its operational and its earnings performance, but that has been a drag, and I think that's down about 19% this year.
So now we can talk about 2025, because again, with valuations so high, I wonder if you're planning to change any positioning in the portfolio, or if you think that the leadership of the market might change, thinking banks, resources, China stimulus. Like, where are you thinking right now, Marcus?
Well, you're absolutely right. Valuations are high, and there's only been a couple of times this century where we've where the market has traded over 18 times earnings. And to put that into sort of historical perspective, the historical average is around 14. And then you've got to look at, well, what does the earnings outlook look for the Australian market? And it looks flat. I mean, we just, if you're looking into the Australian economy, and we've seen that the recent GDP figures are flat apart from government spending. China has been struggling and has had far more muted growth. But given what we've seen in some of the extraordinary movements, our interest is far more galvanised around some of those sectors that have either underperformed or have just had modest returns in 2024. So areas like energy, I think, have underperformed, but I think companies like Santos offer really good long-term value, and they're almost through the sort of the intensive part of their capital expenditure. We are going to hold on to companies in healthcare such as CSL, which has done modestly well this year, but it continues to disappoint, particularly relative to the trajectory of the earnings growth that we expect that they'll deliver over the next three to 5 years. And then on the industrial side, companies like Cleanaway, resilience of earnings, expectations that they can grow their EBIT by 10% per annum over the next three years. So certainly the core focus would be looking at those sectors and those quality companies that haven't participated in 2024.
And just to clarify for our viewers, so you're more interested in large cap companies at Blackmore. Would you be attracted to any of the smaller cap opportunities in the market right now? I mean, there's such a narrative about this switch from the large caps into the small end of the market.
Yeah, I think it's definitely nuanced. I mean, we have a bias around quality and resilience, and so by definition that sort of tends to put us into the more larger companies. But the mid caps is an area that we would certainly look at, and then if we could identify something at the sort of the beginning of its journey, if you step back sort of 4 or 5 years ago, a company like Xero, those sorts of companies would be of interest.